Most people understand stocks. Most people understand mutual funds. But say the word REIT, and suddenly everyone freezes. It shouldn't be that way, because REITs are actually one of the simplest and most powerful wealth tools ever created. REIT stands for Real Estate Investment Trust, and that last word, trust, matters. A REIT is a structure where real estate is held in trust for the benefit of investors, meaning the company must protect the assets and act in your best interest. And REITs aren't some niche corner of the market. In the U.S. alone, public REITs own more than $4.5 trillion in gross real estate assets, with about $2.5 trillion held by publicly traded REITs. There are around 570,000 properties owned by U.S. REITs, and the total equity market cap of U.S. REITs is around $1.4 trillion. Globally, there are over 1,000 listed REITs in more than 40 countries, making this a massive worldwide industry. Now imagine you and 100 friends want to buy a massive apartment building. Everyone puts in a little money, you hire a professional team, and every month you all split the rent. That's the core idea behind a REIT. Big real estate made accessible to everyday people. Back in 1960, only the wealthy could own commercial real estate. So Congress created the REIT structure to democratize real estate investing. If a company invests in real estate and shares most of its profits with investors, the government gives it special tax treatment. REITs operate under some of the strictest rules in the entire financial system. They must pay out at least 90% of their taxable income as dividends. They must hold at least 75% of their total assets in real estate, buildings, land, mortgages, or property cash. And at least 75% of their gross income must come directly from real estate, rent, interest, or property sales. If they're publicly traded, they must disclose everything: occupancy, leases, rent rolls, debt levels. This is why REITs are among the most transparent investment structures in the world. All REITs fall into three major families: equity REITs, which own buildings; mortgage REITs, or mREITs, which own mortgages; and hybrid REITs, which do both. If you remember this, landlord, bank, or both, REITs become simple. Equity REITs own the buildings you interact with every day: apartments, warehouses, data centers, hospitals, shopping centers, senior housing, self-storage, cell towers. Tenants pay rent, and that rent becomes steady, reliable income for investors. Mortgage REITs, the mREITs, don't own property. They own the mortgages behind the property. They borrow at low rates, lend at higher rates, and keep the spread. This is why many mREITs pay double-digit dividends, but move quickly when interest rates rise or fall. Hybrid REITs combine both engines, collecting rent and collecting interest. Think of them as two-engine REITs that work across cycles. And now there's a new kind of REIT, the eREIT, or electronic REIT. These aren't traded on the stock market. Instead, they're offered directly online through platforms that pool investors' money into real estate portfolios. eREITs allow people to start with lower minimum investments, track everything on dashboards, and invest without a traditional brokerage account. But unlike publicly traded REITs, eREITs are less liquid, meaning you can't always sell instantly. Some well-known eREIT platforms include Fundrise eREITs, offering diversified portfolios; Realty Mogul's Income REIT, which focuses on stable, cash-flowing properties; and Streitwise, known for its consistent dividend-focused strategy. In short, eREITs are the modern, digital evolution of traditional REIT investing, more accessible and more online, but with different liquidity trade-offs. You earn from REITs in two ways: dividends, because REITs must share most of their profits, and share price growth, as rents rise and real estate values increase. It's real estate income, without being a landlord. Most REITs use a structure called an up-REIT. The REIT sits at the top, the stock you buy. Below it is an operating partnership, and each property sits inside its own LLC for protection. This structure helps REITs grow quickly, safely, and tax efficiently. Today's REITs look nothing like the REITs of the 1990s. We now have data center REITs powering the cloud, cell tower REITs powering 5G, single-family rental REITs shaping the housing market, life science REITs supporting biotech, and logistics REITs powering global e-commerce. As interest rates eventually ease, REITs historically surge because their yields become even more attractive. Globally, REIT markets continue expanding across Asia and Europe. And ESG matters more than ever. Green buildings and energy-efficient REITs attract institutional capital. Looking ahead, we're seeing early moves into tokenized real estate, fractional ownership, and digital investing. The REIT universe is no longer just about buildings. It's about digital infrastructure, sustainability, and the future of global real estate. If you remember one thing, remember this. A REIT is simply a giant real estate fund that pays you rent or interest every month. Real estate made simple. Real estate used to be a wealthy person's game. REITs changed that forever. Today, with REITs and eREITs, anyone with any amount of money can own a slice of the buildings and digital infrastructure that run the world. Start early, think sharp, learn right. That's your clear path.